Hello and welcome to the final video for chapter 4. Basically we are just going to talk about page 431 in your book. This is a really, even though there's not much on this page, it's a very important topic. When somebody leaves their employer, all right, the employer will give them a form to have them liquidate their 401k. All right, the employer is not going to keep tracking the pension assets for an employee that doesn't exist anymore. And so they will tell you that the money is yours. You can do with it what you want. And it's up to you at that point to decide, whether or not you want to cash it in. And you'll be taxed, of course, on the entire amount that's in the 401k. Or if you decide to do a direct transfer or a rollover. Okay, so what is the difference between the two? Well, if you do not need the money right now, all right, and you plan to use this money for when you turn retirement age, you should direct the pension plan trustee to make a direct transfer. Okay, so transfer to what? All right, well, what you would do is prior to liquidating your 401k, all right, you would set up an IRA with your local bank or, whatever financial institution you want to work with. And then you would work with that bank and work with the pension plan trustee to have your funds directly transferred from your old 401k directly to your IRA. As long as that is done and you never touch the money, in other words, you never get a check or anything like that, all right, there will be no taxable amount. Okay, so again, I want to direct you to the back of your chapter at page 449 and look at the 1099-R for Allison Gator. All right, on that one, Allison received a $22,000 distribution from her 401k. All right, that was a total distribution. And you can tell it's a direct transfer because of code G in box 7. All right, when you have a direct transfer, there will be a gross distribution amount in box 1, but there will be no amount in box 2. But you still have to put it on the return. Okay, don't ignore it. All right, just put it on the return and make sure that box 7 is coded with a G. All right, if you want to double check your work, go back to the first page of the Form 1040. Okay, and what you should see is you should see an amount in box 16A, but you should not see an amount in box 16B. All right, if you do see an amount in 16B, then you made a mistake and you need to go back and rectify that. And obviously, if this was a real tax return, you would not want to make a direct transfer taxable to the client. Okay, all right. So you may get a call from the client during the year saying, that I'm getting ready to leave the company. What should I do? And you should always tell them, do a direct transfer. Get the money into your IRA, and then once the money's in the IRA, they can do with it what they want. Okay, but get the direct transfer done first. Okay, if they don't do a direct transfer, then they do something called a rollover, okay, or a distribution rollover. In that case, what they do is they receive the funds from the pension plan, and then they take that check and then they roll it over or put part or all of it into their own IRA. Now, there's a big drawback to this, and it mentions this on page 431. All right, when the pension plan company sends you a check, Okay, what they're going to do is they are going to send you the check, but they are going to withhold 20% for federal income tax. They do not withhold anything for state income tax, at least not automatically. So let's say you had $100,000 in your 401k at work, and you don't pick the direct transfer method. Okay, well, that means that they're going to send you a check for $80,000, and they're going to send the other $20,000 directly to the IRS. Okay, and that will be reported on the back of the 1040 as, taxes withheld from a 1099. All right, that is probably not what you wanted. All right, and the bad part about this is that if you don't want the $80,000 that you received to be taxable, you not only have to put the $80,000 into an IRA, you also have to put the other $20,000 into an IRA. Now, the pension plan trustee has already taken that $20,000 and sent it to IRS, so you have to come up with $20,000 on your own, and to match it with the $80,000 so that you can get the entire $100,000 total into your IRA. So this is why I mentioned, unless you need the money right now from your pension plan, just select the direct transfer method and forget about it. Okay, that way no monies are taken out of your with your distribution, and everything is cool. Okay, by the way, it does mention to you that the mandatory withholding rule does not apply if you are transferring from an IRA to an IRA. So for example, you've got your IRA with Fidelity Investments or something, and you find out that Vanguard Investments has a better IRA, so you decide to switch it from one to the other. Okay, that 20% rule does not apply. By the way, one of the advantages to listening to this video is I try to give you tips once in a while. All right, you will have a question on your test that deals with the example at the bottom of page 431. So when you're taking your test, and remember there's no time limit, all right, you might want to come back to page 431 to answer that test question. All right, that ends the discussion for chapter 4.